Hi, everybody. I spend a whole lot of time and energy trying to keep things simple. The reality is the world of investing can be made as complex and complicated as we choose. Or we can simplify to what's really important and disregard all the other gobbledygook and fancy financial jargon that tends to just get in the way. In the next 6 minutes, I'm going to show you a simple approach I use that you can deploy too, to likely improve the quality of the investments inside your nest eggs. Here goes. And we need to start with a fundamental premise. I believe index fund investing is a rock-solid way to invest for almost everybody. It checks off a lot of boxes. Low cost, transparent, consistent, and simple for starters. For those of you who aren't sure what index fund investing is, here's a definition taken straight from Vanguard's website at www.vanguard.com. Feel free to pause this video to digest. As great as indexing is, there are opportunities for smart investors to harness research in modern financial science in pursuit of doing at least a little better. And when it comes to long-term investing, my specialty, even a little better can add up to a whole lot. Let's take a look at the methodology of this research, shall we? Let's say this 4x4 matrix of 16 rectangles represents all the building blocks of a stock market index fund. Each rectangle represents a subset of the fund comprised of hundreds of companies with different characteristics. For example, the green rectangles depict subsets that contain companies with superior profitability and higher book to market. Sorry for the jargon here. Sometimes it's hard to avoid. Another way of describing a company with a high book-to-market ratio is as a value company. And as the term suggests, this usually means you're getting more of something. More what? More of a company's equity, that's assets minus liabilities, as a percentage of the price you pay. So let's quickly summarize. The green rectangles are comprised of companies producing solid profits that also give shareholders more equity. That sounds pretty good so far, right? What about the red rectangles? Let's think of them as pretty much the opposite of the green. Low or no profit companies that give shareholders much less equity as a percentage of the price they pay. Now let's think for a second. Who would want to buy these types of companies? If you believe the best is yet to come for them, and you're willing to pay a higher price for a piece of this yet to be recognized potential, these stocks are for you. A growth stock is the commonly used term for this type of investment. What about all the white rectangles is the next logical question. The stocks in these rectangles possess blended profitability and value characteristics somewhere in between the extremes of the green and the red. And now when you look at all 16 rectangles in aggregate, green, red, and white, you're looking at the entire universe of stocks or its investable product, an index fund. Okay, enough definitions and explanation. So now let's take a look at the research comparing annualized rates of return between these two groupings and then versus the entire field. What story do the numbers tell? For the 48-year period from 1973 through 2021, the results are compelling. When it comes to the annualized rate of return performance of all the companies in our green rectangles, they significantly outperform their red counterparts for both large and small U.S. companies, 16.51% to 11.18% and 19.86% to 9.32% respectively, while also outperforming the aggregate performance for the entire universe of large and small company stocks, represented by the 12.44% and 14.80% rates of return in gray. Here is a hypothetical showing what these returns would look like after deducting a 1% annual management fee. This is just one example. But, very importantly, this outperformance is not every year, nor is it according to any predictable pattern. In fact, it's not unusual for individual years or periods of time for that matter to produce results startlingly different. So, what do I do to harness this research in pursuit of higher time-tested returns for my clients? And what can you do as well? I invest in broadly diversified mutual funds, or ETFs, that largely replicate the entire stock market to get a piece of all the action whenever it occurs. Remember my caution. But also systematically overweight holdings of companies in the green and underweight holdings of companies in the red versus their actual market weightings. So there you have it. As I said when I introduced this topic, stock market index funds are rock-solid investment solutions, and they are great for almost everyone. But if you can harness the power of modern financial science and research to possibly do even better, you owe it to your nest egg to understand how. Want to learn more? Please reach out and let's schedule some time to talk. All for now.